Hello, my name is Rachel Vahey. I work in AJ Bell as a Senior Technical Consultant. I wanted to talk with you today about what responses government and regulators have made to the COVID-19 outbreak and what responses have affected pensions and savings. There is no doubt our world has been turned upside down in the last few weeks. The outbreak of the COVID-19 virus has meant enormous changes to almost all parts of our lives. We are now living in lockdown, exercising social distancing, and it seems our lives have changed significantly. The effect of all these changes reaches wide, and that includes to pensions and savings. Government and both regulators have been considering the current rules and how they should change at a time when the markets are experiencing economic turmoil, and both providers and advisors are focusing on helping their customers, but also adapting to lockdown life. Priorities for government and regulators have changed massively over the recent weeks as they concentrate on the immediate issues to hand. They've also had big changes in their own staff. Some people are off ill, some people are self-isolating, a lot more are working from home. And this has had the obvious knock-on effect onto their current workload and meant delays to our normal business of receiving consultations and responding and getting new policy statements. Today, I want to cover some of the main changes that affect pensions and savings. Things like the 10% drop notification and what's happening with DB transfers. So let's start with the MiFID II 10% drop notification. Now, I imagine that you know all about this particular rule anyway. It was introduced largely through European regulations, and it wasn't one that the UK pushed for. In the European markets, most products are bought through bancassurance channels, and people lose touch with their investments. And the intention of this particular rule was to bring them back into touch. Just to give ourselves a brief reminder, in a 3-month period, at any point, if the portfolio drops 10%, firms are required to contact the client within 1 business day. So they have to drop everything and do this immediately. If there's a subsequent 10% drop, then they have to get in touch with clients again. Now, in the current climate, we've been repeatedly sending out notices to lots more people than usual. And this is pandering to some behavioural aspects. And there's a worry that we're going to scare clients into making decisions that maybe aren't quite suitable for them at the moment. There's also a problem with allocation of resources. Manual intervention is usually needed by firms to make sure these notifications go out, and especially within the 1-day timescale. So we need to put resources there to help us achieve that. The good news is that the FCA has reconsidered this and decided to relax the rules somewhat. They have said that there will be no enforcement action where the firm issues at least 1 notification indicating a 10% drop in their client's portfolio. They don't need to issue the subsequent notifications. Now, that's provided they're giving general updates to clients to keep them informed of the market conditions, how to check their portfolio values, and how to get in touch with the firms. And these general updates are just generic updates, which can be through social media. Firms can also choose to stop providing the 10% depreciation reports for any professional clients. This relaxation is really welcome. The process of providing continuous client notifications was causing many firms excessive amounts of work for very little obvious benefit for clients, at a time when resources could be redeployed much more usefully elsewhere. This isn't, the client getting a 10% letter is not going to realise for the first time that the markets have fallen. They're well aware of that already. And many more clients have many more important things to worry about at this time than the 10% drop notification. However, it could be argued that this relaxation is of limited use. We are now into a new quarter and a new period of checking whether the 10% drop has happened. So any further drops in the market firms will have to send out another 10% notification. AJ Bell will send out one 10% notification, but it won't send out any subsequent other ones. The FCA has said that it will adopt this approach for the next 6 months until the end of September. I really believe that this is a time where advisors can add tremendous value to their clients. Clients need reassurance, and a friendly phone call or a video conference will go a long way to giving them that reassurance, and it will demonstrate that their advisor is there for them to help them through this time. So moving on from the 10% drop, let's look at some other angles. First of all, furloughing employees. Now, realising the severe economic situation that we're going to get into, the government has stepped in to help people and help employers continue to pay staff to avoid them being laid off. Employers can choose which employees to be furloughed. It's for a 3-week minimum. And after that, they can decide to, for want of a better expression, unfurlough them. So they can start working again for the company full time. They can swap them in and out of furlough. At the time they are furloughed, they cannot work for the company. They have to be inactive. But they can work for other companies. Employers apply for a grant from the government, and the government will pay up to 80% of the salary, which is up to £2,500 a month. That's the maximum. There is also help for the self-employed. They can claim a taxable grant as long as they filled in a 2018-19 tax return. Now, this is a really strict cut-off date. We're already in the new tax year, so you sort of wonder why the government can't base it on the 2019-20 tax return if self-employed people file that really quickly. But the answer is the government's not going to look at that at all. It has a cut-off date. You have to have a tax return, which is for the 2018-19 tax year. And 50% of a person's income must come from the self-employment. The grant is decided on the profits over the last 3 years. The downside is it's not going to be paid until June. The self-employed don't have to do anything to claim it. The government will get in touch with them and they can keep working, but they're not going to get any financial help for another few months. Directors are employees of a company, so a company could decide to furlough a director. If that's the case, as I said before, they cannot continue working for the company. They have to be inactive. But directors have statutory duties to do and they have fiduciary duties to do. So is it really possible to be inactive? The indications are at the moment that directors can continue to do the absolute requirements they have to do, the statutory requirements they have to do, things like filing company reports and things like that. So they might be able to do that and continue to be furloughed. Any money they receive will be based on their salary only. It won't be based on dividends. Companies that decide to apply to furlough their staff will also receive, as well as the 80% of their salary, they will receive a minimum employer contribution in the government grant and the employer national insurance contribution as well. There's a few things to note here. It's only the minimum automatic enrolment employer contribution that they can claim, so only 3% of band earnings. And of course, the band earnings limit is subject to the furloughed cap, so it's going to be less than £50,000. The furlough doesn't change the contract of employment. So if the employer already promises to pay more than 3%, then they have to continue to do that, even though the grant will only cover 3%. And employers can only claim for employees who are already part of the pension scheme. They can't add new people in and then start claiming for them as well. It's worth noting that the money that the employee receives, the grant money the employee receives, will be taxed and it will count as their relevant earnings when you're looking at how much contributions they can pay in for the 2020-21 tax year. Let's look at an example. Meet James. James is a hotel manager. His employer furloughs him and he receives 80% of his salary. But his 80% of his salary is equal to £2,800 a month. So that is capped or reduced to the 2,500 maximum. His employer also claims his pension contribution. That's £59.40. James pays his own 4% employee contribution and there's a 1% tax relief added in. When you're looking at all three of those, that gives you a total of £158.40. But think about what James was receiving before. He got a previous contribution of £238.40. I think we're going to see this for numerous employees over the country. They're going to have a hole in their pension savings compared to what they would have normally earned. So they may want to think about taking action. It really depends where they are on their pensions journey, whether they're at the beginning or whether they're at the end, and what they want to do, and also what their financial position is like once we come out of furloughed period. But some people may want to rebuild their pension savings and just fill that hole which has been created over these few months. Let's go on now to look at investment pathways. This is an initiative from the FCA that affects non-advised drawdown clients. The FCA want to make sure that people make better investment decisions. The new rules come in on the 1st of August, and drawdown providers are currently working on this. Let me just start off by explaining very simply what investment pathways is. A client, a non-advised client, who starts taking drawdown for the very first time, or switches or transfers from one drawdown contract to another, will get a choice of three options. They can go into investment pathways, they can stick with their current fund, or they can choose their own funds. If they go for investment pathways, then they will be asked to choose an investment pathway option. They're given 4 options about what they want to do with their drawdown fund over the next 5 years, and they have to pick the one that correlates best to what they want to do, with their intentions. Once they've picked an option, it could be, I want to buy an annuity in the next 5 years, or I want to take out all of my fund in the next 5 years, then the firm has to offer them a pathway investment. Very confusing jargon, all of this. A pathway investment is just a default fund. If they go with the current funds and they decide to stick with their current funds, then the firm needs to check with them that whether their choice meets their investment strategy. If they decide to stick with their current funds or to choose their own funds, then if they have invested more than 50% cash, the firm has to give them an initial cash warning. And we're going to say things to them like, are you sure you want to be invested in cash? Do you realise the risk of continuing to stay invested in cash? And what happens with inflation? And then if they choose to stay in cash and they don't invest elsewhere, we have to give them a warning every year to say, are you sure you really want to do this? So that's the essence of investment pathways and what the new requirements are going to bring in. This is due to come in on the 1st of August, but drawdown firms are under pressure to get this through. Now, very good news is that the FCA have said that they're going to delay this implementation to the 1st of February 2021. So we have a 6-month delay. The FCA has recognised that it's going to be difficult for drawdown providers to introduce this, partly because the rules are quite difficult to work out and exactly how they apply to platforms and to bespoke SIPs and to member directed SIPs. So it's really quite difficult to understand exactly how to implement this. So we're very pleased that they have decided to delay this for 6 months. However, we do think that this is a chance for a fundamental rethink. There are a few obvious flaws that come up when you think about how investment pathways are going to work in today's environment. Do we really want to tell clients to invest into one fund on one particular day? Do we really want to warn them against holding cash and say, come out of cash, go into something else? That's by far the better option. I don't really think that either of those things really holds true in today's environment, and probably just shows up the flaws of investment pathways policy. I very much hope that the FCA takes this chance just to have another think about investment pathways and whether it is the best way to try and help non-advised clients make better retirement and investment decisions. So let's leave investment pathways and go on to DB transfers. Now, the pension regulator has been looking at the area of DB transfers. It is very worried about people getting scammed out of their retirement savings in the current environment. All the regulators are worried about this, and they've all bunched together to urge savers to keep calm, take time, and don't rush into transfers or retirement decisions. The pension regulator has published guidance for trustees at this time. They've been talking to them about administration, about funding, about how to pay contributions to pay off debt. But they've also said to trustees that they can stop DB transfers if they want to do so. They don't have to, but they can choose to do it. Now, trustees also have some leeway about what they stop. They could decide to stop any further requests. So if they get another request in for a DB transfer, they may say, well, no, we're not going to do that. We'll just leave it for the present moment. Or they could decide to stop any payments. So even though somebody has requested a DB transfer, they've got the quote, they've gone and organised the rest of it, they've gone so far down the process, they might now not get the payment if the trustee has decided to stop DB transfers altogether. Advisors working in this field will need to find out what the current situation is. If they do have a DB transfer case on their books, they will need to know what approach the trustees are taking. And the trustees might not yet have decided this. This is just another step in an already very tight process. And there is a worry that it is going to hold up the process even further, and it may make it more difficult to complete. If trustees do stop DB transfers, then clients looking at wanting to do this will have to wait until they start again. And the transfer value could then be different. That could change any advice already given. And it may mean that advisors have to carry out more work to reassess it, to have a look at what the current position is and whether the advice is still suitable. This raises issues for advisors when they're looking at fees. Do you charge for the work you've already done? If you have to reassess it because you don't think the transfer value is no longer suitable, what do you do then? This potentially looks like a bit of a mess. The FCA has also issued some guidance about advisors working with DB transfers. The first thing to say is that they have delayed the new qualification for pension transfer specialists to October 2021. So that's good news. It gives us all a little bit more time to be able to achieve those qualifications. But they've also given guidance to advisors about what they should be doing in the current situation. And a lot of this is just common sense and reiterating the sensible approach that advisors take towards DB transfers. You have to demonstrate that the transfer is still suitable. And the FCA has asked that you address some consumer misconceptions. Consumers and advisors shouldn't assume that the change in circumstances means transfers are more likely to be suitable. So some consumer misconceptions could be, well, the transfer value has gone up, so therefore it's more suitable to transfer. That isn't necessarily going to be the case. There's going to be a bigger emphasis on death benefits in the current environment and the fact there may be better in defined contribution. But the FCA warns against that and says, just remember about alternatives, for example, life assurance policies. And also some clients are going to be worried that their employer may go under and that the pension scheme may too. Advisors should just remember to give a fair assessment of the PPF. And that's what the FCA is going to be looking for. I think this just sounds like the same analysis and the same sound basis that most pension transfer, most DB pension transfers are judged against. So it sounds like just a continuation of this. The FCA has been explicit that they are continuing their DB transfer work, so they will be looking at files over this period. One last thing to mention about DB transfers. The FCA has put back their policy statement. They were looking at introducing a ban on contingent charging, as well as a new type of advice, abridged advice. But that policy statement has been put back for a few months. So there's quite a lot of changes there in DB transfers. I want to now look at the general levy. Now this could have slipped under your radar. The pensions general levy applies to all pension schemes and depends on the type of pension schemes and the number of members within the pension scheme, and that depends on how much they pay. It's paid to cover costs from the DWP, for the pension regulator, and also for the Money and Pension Service. There was a consultation earlier this year, and the DWP decided to significantly increase the levy by 10%. Now, this probably sounds quite familiar, an increase in levies to pay for services for MAPS and TPR and other organisations. However, the DWP has now decided to withdraw this increase for this tax year and put it back for a year. This is good news. They're also going to have a good review and to decide how to treat this levy in future. So moving away from the general levy, let's finish off by looking at consultations. The regulators and the government are under pressure, the same as the rest of us are. We all have problems with staff and with adjusting to our new work from home lives. So the FCA have said that they're going to extend closing date for consultations and calls for input to the 1st of October. They're also delaying expected consultations and guidance. So we were expecting some things on vulnerable customers, that's been delayed. And we were looking for things on non-workplace pensions as well, personal pensions and SIPs. But that's also been delayed for a few months. And as I said before, they're delaying some policy statements as well. For example, the one on DB transfers. The pension regulator is also suspending all of its regulatory initiatives, so it's no longer taking work on that. And when you're looking at areas of government, for example, the DWP, at the moment, all their focus is rightly going on paying benefits to people who really do need them. And this is going to distract them from other areas of their work. But that sounds right, and rightly so. There is a pensions bill which is currently going through Parliament. This pensions bill is looking to introduce new powers for the pensions regulator, but also pensions dashboards. However, it's due to enter the report stage after the Easter recess. And I think we need to just see what happens with that and whether it gets further delayed. The situation is still changing. It seems like we're getting new announcements every single day on these areas. So we're going to get other announcements and we're going to get further clarification. But it is a time, I think, that where clients are really going to be looking to their financial advisor or planner to help them. They need help negotiating the financial turmoil of the next few months and just for reassurance. So I really believe that financial advisors and planners have a lot of value to offer their clients at this moment in time. Thank you very much. I hope you have found this session helpful. If you do have any questions, then please get in touch and stay healthy.